Hey, what's up, guys? Once again, it's me, your boy Jermaine Houghton. Thank you for allowing me to become your Forex mentor. Just want to say I'm going to lead you on the path of success, but you can only go as far as you want to go, okay? It's only going to take you as far as and as hard as you want to work. So, in the last video, I kind of ran over on the time, talked a little bit too much, so I'll make sure I try to keep this one short. In the last video, we talked about what a trend was when we were making consecutively higher highs and higher lows, or for an uptrend, or in a downtrend where we were making consecutively lower highs and lower lows, right? So I'm going to show you guys now in this video how to use the Fibonacci tool, and I'm going to have you guys go back and look at different trends and kind of show you how this tool works and why a lot of traders use it. Now, the Fibonacci tool, let me pull it up here. I'm going to actually hide the chart. I'm just going to pull the tool up so we can look at it. The Fibonacci tool, this was one of the first things we set up in one of the first videos. So when you click at one point and you click at another point, usually the high and the low. So let me go ahead and do that. This is the low. All right, you always go from high to low. If you're doing a downtrend, you go from high to low. If it's an uptrend, you go from low to high. But we'll talk about that. But what this is telling you here is you have these different ratios here, and this is the price. So this is a 38.2% of, if the market fell from here and then it came back to touch this line, that means the market gave up 38% of that down move when it came back to this point. Same thing with this 50% line. So if the market drops and then it comes right back and touches this 0.50 line, that means that the market gave up 50% of the move that it dropped. 61.8. This is what you call the golden ratio. You're going to see this occur a lot. A lot of times, if the market's going down and it comes back, it'll stop right here and continue its way down. This is actually the magic number in 61.8. There's actually a certain number sequence after like the third or fourth number, you're going to get 61.8, and you're going to continue to get 61.8 forever. So that's what the guy, the mathematician Fibonacci, found out, and that's why they use his numbers, because he realized that this number occurs over and over and over again in nature. Now, the 786 is also a Fibonacci number, and so is the 886. Now, 50 is not a Fibonacci number, right? But we have it on there because the market a lot of times will come back and touch that 50% and continue on its way. And as you'll see later in other videos, that's how we actually look for our trades to set up. So let me go ahead and erase this, and I'll bring the chart up, and we'll actually go over an example of how to actually use this Fibonacci tool. All right, so here we have a move from here all the way down to here, right? That was a move that trended down from this high all the way to this low. All right, so the way you use your Fibonacci tool, bring this chart down, is you want to start from that high of the move, because it did trend down, to that low of the move, right? Because we didn't see this part yet. So the market came down, pulled back to the 38.2%. See that? Let's enlarge that. All right. Market came down, pulled back to the 38.2, stopped right on it. It's not coincidence, right? And then continued its way on the way down. So that's what we're going to show you is, when I showed you in the last video that the market was making higher highs and higher lows, well, you're going to see that those are going to coincide with this, right? So now the market's continued on its way down. So let's measure it. It fell all the way down and it didn't stop until here, right? Well, let's look what happened again. Let's take a look at that. Stop right there. Well, now when it came back up, it stopped at the 50% and fell. Then again, it stopped at the 61.8 and fell. It stopped at the 886 and fell. So even though it started moving back up, it started doing stuff at these different levels that could have provided a trading opportunity for you if you know how to use the tool. Now, this is using the tool in its most basic form. You use this to get in on a trade going in the direction of the trend. So this trend was trending down, and if you saw it stop at a certain place, you can say, okay, it stopped right here, and it's probably going to go back up some. But I want to see which one of these it's going to stop at, because it's going to probably go lower again. So let me look at a couple and I'll show you over here. Even though it started moving back up, so we have an uptrend, right? Here we have the market found this low, found this high. Well, get your Fibonacci tool, start from your first point of reference. We'll call this point of reference A, okay? So first of all, let me put some structure towards this, and we'll say, okay, this is my point A. Let's make that black. So this is my point A. I'm going to use this as my point B, okay? So let's put there a B right here. All right, and the way you use the Fibonacci tool is you always go from point A to point B and measure it out. So you're going to say from A to B, so what the market did was it went, we already have, what you're going to see is you're going to have this information here already. You're going to have something like this. And you're going to say, well, it stopped at B. I'm going to see how far back in it pulls back, so maybe I can get in on the trade at one of those levels. All right, so it pulled back, and you can see it came all the way really, really close to the 61.8, right? If you're looking for a trade in the direction of the trend, that is always a good area to get in at the 61.8, right? And it should bring you back in the direction of the trend, because the next high should be higher than what B is. So once you get a move from A to B and you were figuring, hey, this is the direction of the trend, when you see it's going to pull back, you pull your Fibonacci tool out, measure from A to B, and see which one of these, and you can go ahead and let it bounce first. You can say, okay, it stopped on the 61.8 and it started going back up. I'm going to get in, and you should go higher than what B was, right? So we went higher than B, as you can see, right? Now, that's just the first example. Let's go through a couple so you guys can get used to it. All right. So as you can see, we kept going higher and we never violated this point here. So if you got in, you were good to go. All right, let's take another move, and literally any move that goes up from a point A to point B, you can measure. So we can actually take the next move in the sequence, the next up move. We can say that we had A right here, and then B was right here, and same thing, same strategy. You get your Fibonacci tool out and you measure that move. You say, okay, from point A, which was this low, make sure you get the low, click on it and go to point B, click on that, all right? And what did that come back? How much did that come back? Let's see here. I don't want it to be jumbled up. Let's make it large so everybody can see it. Well, you can see my line right here is the 61.8 line. That market came back to the 61.8 and bounced and continued on its way up and went higher than this B. So we definitely have the anatomy of an uptrend. Remember, I kept telling you in the last videos, those higher highs and higher lows. Well, majority of the time, the higher low is going to coincide with one of these Fibonacci. They call them retracement levels, or basically, a retracement means how much did the market come back after it went forward, right? It's like your car. It's like if you were in a car and your car went 20 miles, and then all of a sudden it came back 10 miles in reverse. That's basically what this Fibonacci tool is telling you, that at these different levels, If the uptrend is going to continue, it should stop. Now, it should not violate A, because you're going to continually have higher highs and higher lows. If it violates A, then you do not have a higher low. So let's do another one, right? Let's do one the opposite way, because nobody's really used to the market going down. So I have to give you guys a lot of examples that we're just doing everything in reverse when the market's going down. So let's get a good example going and find where the market's dropping. Okay, here's a good one right here. I don't have to see anything else. Here the market, we had a high and we have a low. So we have an A and a B. Let's get that. Let's mark that in, all right? My A point. And I want you guys to, just for good practice, put these letters in when you're doing it, just so you know where you're at and kind of be familiarized with how we're doing this, all right? So I have my A and my B. Now I always measure, like I said, from A to B, right? And look where this market came up. Well, the market fell, it came back up, it stopped at the 61.8 one time, then it stopped at the 786. These numbers, like I told you, you can use just those two numbers, the 61.8 and the 786, because they're magic in a trend. Majority of the times, if the trend is really strong, it will not get back to the 61.8 or the 786. It may get back to the way you gauge a trend that's strong. If it only comes back to the 38.2%, that trend is strong, because what that means is that the bulls have a lot of momentum, because or in this case, the bears have a lot of momentum if it only comes back to the 38.2, because it's kind of like saying when the bears are on offense, they took this thing all the way down here. Then all of a sudden the bulls got on offense, but they wasn't able to get any kind of offense going if it only stops at the 38.2. If they get it back to the 61.8, that was actually a win for the bears in that scenario. But most of the time, if a downtrend is going to continue, it will stop at one of these ratios. It should not exceed A if the downtrend is going to continue. Okay? So here we have it. It came back, and it came back to this exact bottom. It didn't break it. It didn't make a lower low. That is going to send off a signal in my head that, hey, why isn't it breaking this? Because I'm expecting it. If the downtrend is going to continue, I need a lower low than B. All right? So that's how it looks in a downward move. Let's find one more example. This is actually live now. So in this case right here, this is a good example, because this is actually live now. This is exactly what I would do. This is how the market would look when you're getting ready to draw this, because I have a down move, so I'm going to mark that as A. All right. I'll bring this down. There we go. There we go. There we go. And I'm going to actually mark this as my B, because what I have the market came down and then it started going back up. So I know this is A, I know this is B. Now, I'm going to make an assessment. Is this downtrend going to continue? Well, what I'm going to do is I'm going to draw my Fibonacci levels from A to B, and currently we're trading around the 50%. Right? And you can kind of see that it's stalled here a little bit, but it hasn't started dropping from there yet. So it may be able to get back into the 61.8, or who knows, it can go right through this. But me as a trader, I'm going to make the assessment. If I see it hit the 61.8 and start to turn back, I'm possibly going to put a trade on, because it's going to give me a good risk to reward where I can put a trade on that I can say, well, it's not supposed to make a higher high, because this is a downtrend, right? Remember, I told you the trend is your friend. It's not supposed to make a higher high. So if it hits the 61.8 and starts to fall, I can let that happen. I don't have to get in at the top. I don't have to get in at the bottom. I can let it